Hello and welcome to Investors Platform. Today's guest is a key artery of my power team with over 20 years of experience. Many refer to this man as the oracle of mortgages. Mr. Matthew Finney, thanks for coming on today, mate. How are you doing?
Thanks, Joe. Yeah, not too bad, thank you. And yeah, cheers for the invite.
Excellent, good stuff. Yeah, so 20 years of experience, Matt. How did it all start and how did you become a mortgage broker you are today?
Yeah, interesting question. So I first started off in the admin team of a large building society, not directly dealing with clients, but I enjoyed the whole process of mortgages and wanted to go further into it. So I joined a secured loan company, working on the phones, dealing with clients, listening to their inquiries, problems, and helping them get to the right team so they could get the loan that they needed. And kind of happened across it by accident, really. I called into my local branch of a bank to pay a check in. That's how old it was. And the manager invited me into the office to have a chat because she was interested because I came from Buxton, where she'd come from. And we had a chat. She asked me what I was doing and mentioned that she was looking for a mortgage advisor in one of the group's branches in my hometown of Buxton. So I jumped at the chance, went through months of training, and then started my exam revision at that point, really, which is CMAP. And then I was working in a branch, which was quite scary to start with.
Yeah. So how many years have you had CMAT qualifications now
I passed my CMAP 19 years ago.
So you've seen the true ups and downs of a market. I think they say there's 18-year property cycles. Is that right? And so you've definitely seen the best and the worst case scenarios in your experience.
I've worked for are no longer around. A lot of the lenders that we used to use, they've gone. So the market adapts all the time, and you have to be able to adapt with that.
Yeah. Yeah, so obviously we've entered a bit of a shit market. Obviously, I've only been investing for 2 years, but when I first started, it was pretty good in terms of like the rates and everything like that. In terms of like actually getting onto the property ladder, 2020 was a pretty good year. Sorry, 2022, I should say, was quite a good year. So let's dive into the state of the market today and over the past years. And what do you think are the drivers behind it?
That's an interesting one, is that we can kind of split the residential and the buy-to-let market, but for the purpose of this, we'll focus on the buy-to-lets. Is interest rates went up. Now, part of the driver of that, irrespective to me of what the press says and what the expert in the pub says, is lenders were getting inundated with business. So to take them off the top of the table when advisors like me are looking, they put rates up 0.25%, put a valuation fee in, so they then drop down the table. That then exposes another lender who gets inundated, and they do the same. And it became a race to the bottom. So everyone followed suit, and they just kept increasing rates, removing incentives, putting in horrendous arrangement fees to deter people from doing business. Now, if you're coming up to remortgage and you were on 2.5% for 5 years and your interest rate's going up to 7%, your payment goes up. So to counteract that, what landlords were doing was increasing the rent.
Yeah.
Landlords were selling the properties because it was no longer viable. So then we got less rental properties on the market, greater demand. That further drives the rental cost up. So it's like a lose-lose scenario.
Yeah.
It's terrible, really.
Yeah, well, I've certainly noticed it with in terms of rental demand. There's just not enough housing stock to go around. So what do you think? What do you think the banks can do about it, and what do you think that the government are looking to do from your research and experience?
And it's staring them right in the face, is drop the interest rates, because lenders don't really go off what the Bank of England interest rate is. They do and they don't, but they can do an awful lot more to drive the market.
Mm.
Everything went up post-COVID, utility bills, council tax, and mortgages have skyrocketed. That then has a negative impact of repossessions, people having missed payments on the mortgage, bad credit. It's like a self-fulfilling prophecy. So they need to step in to force the banks really to say, you've got to drop your interest rates.
Yeah.
You've got to stimulate the market, because it's not just lenders that would struggle, which they never do, it's then solicitors, estate agents, builders, home movers, your tradespeople who are coming in and, doing home improvements, that kind of thing. So the answer is there, staring them right in the face, and no one's doing anything about it because the banks win.
Because from a buyer's perspective as well, in 2022, you could get interest rates of 2-3%. But they're now looking at 2024, where they're looking to remortgage onto 5-6%. So have you seen people struggling to kind of come up with up against these interest rates? Because that is a substantial amount, isn't it? More to pay in interest per month.
Very much so. I mean, the area that I live in, Derbyshire, house property prices aren't sky high. So it's making a difference, but not a massive difference.
Yeah.
I deal with clients in the southeast where they're living in £1 million properties and they've seen their mortgage skyrocket. Now, what people do when the essential bills increase is they then cut back in other areas. So recreation, going on holiday. And one of the big things that I've really seen that to me is very dangerous is they either don't take life insurance or income cover, or they've had it and they've cancelled it. So they're exposed to a massive debt and a massive problem if anything did go wrong.
Yeah.
I'll use a quote from my dad when on the very first day of the bank. He said, "A bank will give you an umbrella when it's raining and take it away when it's sunny." And I never understood that when I day on at the bank. I had my suit on, and I realised exactly what he meant is take that umbrella away if you can't pay the mortgage.
I think going back to like the lending side of things, there've got to be some improvements in the next few months, surely. So obviously we discussed before about banks working in quarters. So we're now reaching the end of Q2. They're going to start wanting to push targets, aren't they? And that sort of thing. Do you think that's true or not? Do you think they're going to continue to keep the interest rate where it is? I know it's not really up to them with the Bank of England, but they can definitely increase or decrease it, can't they?
I mean, you hit on the coming up to the end of Q2 is they would have had a target to reach, and depending on who comes up when we look at mortgages, you can see where they are on their target.
Yeah.
Do they need more business? Have they got enough business? But also they start looking at Q3. Is what have they, because they need to start putting the business in at the start of Q3 to be able to get it by the end of that quarter.
Yeah. So it's very difficult to. You're essentially stabbing in the dark, aren't you, with everything like that? But I suppose from your experience of being in the market for such a long time, sometimes history repeats itself. So can you predict where the market will go over the next couple of years, maybe like 2 to 5 years or further down there?
I'd love to have that crystal ball to say it's how I would like it to go, but it's like I mentioned about the self-fulfilling prophecy. It's doomed if it continues on this path, because we reduce the amount of rental properties down, it increases demand. People are going for rental properties like people were buying in COVID and in the pre-credit crunch 15, 16 years ago. If a rental property goes on the market, there's 10 people viewing it, they start offering over what the monthly rental is, and the landlord is then they've rented the property out. So there is that shortage of good quality rental properties that needs addressing.
Yeah,
because people have nowhere to live, or they're living in very substandard property. So they need to drive the buy-to-let market. They are unregulated. Buy-to-let mortgages, if you rent it out to somebody on an AST, they are unregulated by the FCA. So the FCA are kind of stepping away from it. From our perspective, we have to look after the clients exactly the same, but the regulator needs to step in here and say, this is not fair. This is not fair. We need the landlords, the hobby landlords who've got one properties, the portfolio builders like yourself, and then you've got landlords with like 100 property portfolio.
I'm very conscious and I want to create a good service for my tenants, but I think that regulation isn't a bad thing sometimes. Bringing in will actually create some form, like you say, it's unregulated and people can just get away with whatever they want, you know, because they don't want to spend the money sometimes necessarily.
Yeah.
And it gives landlords a bad name, but actually we're serving a very, you know, well-needed service in England, aren't we?
Absolutely that. As you know, the social housing was sold off under Margaret Thatcher, under the Right to Buy scheme. That then narrowed it, forcing people, not forcing people, but you know, allowing people to buy the property, and then they were sold on as a massive profit after the 5-year period that you're not allowed to do so. So
Yeah.
again, it's had a double like whammy of beatings. But you know, for giving somewhere people to live where they can't get a mortgage, because not everyone can get a mortgage.
I wanted to transition that into property as a whole is not a rich, quick scheme, and taking professional advice as well as going to courses to see what's possible. From my perspective, if you're getting property, it's a long-term investment. So I wanted to discuss like if you've come against landlords that you know wanted to get in, want to you know see the return straight away, then rather than seeing the bigger picture of it all.
Sure. I mean, I don't use it myself, but the likes of TikTok and Instagram Reels and that kind of thing is there's a lot of people giving advice who aren't qualified to do so first and foremost. And maybe they've, you know, come from a line of money where they show how it's done when they've got money in the bank. The other aspect to see is I had a client who had racked up credit card debts of attending courses of how to become a buy-to-let landlord and make money from it. There's only one person making the money from that, and that is the person running these courses and charging £2,000 odd for each one. That person could have come and spoke to me for free, and I could have provided the advice on what to do and how it should be done legally, professionally, and have the support of me throughout that process.
Yeah. Well, that's right. Yeah, and that's why you speak to someone who's a professional like yourself, who you'll essentially guide you through the good parts and the bad parts, you know, phases of the market and stuff like that. You are there on the behalf of the buyer to prevent someone from getting stung, aren't you? So it's within your interest to make sure that they're successful for repeat business. So when you look at it from that angle, speak to a professional, speak to someone who's regulated, who's in the industry doing this stuff every day, and you can do it for free.
Yeah, chatting to me costs absolutely nothing. I often tell clients something that they don't want to hear. I tell them, do not buy that property.
Yeah. I remember when I first started out, and I was speaking to yourself, we would talk for hours about, you know, my circumstance and how the nuances of, you know, my circumstance relatively to someone else, and it's all varies, isn't it? It's not there's not a cookie cutter strategy for everyone. Everyone has their own individual circumstances, like different income levels. So it will vary very much. It varies, isn't it, on the person? So you need to have them conversations with yourself.
I mean, we have a fact find, which to me is a two like fold approach. Is you have your information that you have to have, name, address, date of birth, income, expenditure. There's a lot more within that, but I get an awful lot of my information by, like I did with you, like we're doing now, just chatting. Where do you want to be in a few years? Why are you doing this? How are you going to do this? Can you afford this? Is this the right thing to do at this time? Is that the right property? Is there a better one out there? Is that, to me, is where you then can place the correct mortgage lender product to the client, knowing what their future plans are is a big one. I mean, Sorry, Joe.
I was going to say, just to be very clear, I think education is important as well because you need to have, these courses do teach you how to get involved and build up confidence. And I'm not saying don't do them, but what I'm saying is get professional advice as well as that, and networking as well because this is a business as well, Matt. It's not like I say, it's not a rich quick scheme.
Is particularly with the costs of setting up buy-to-let mortgages nowadays, which again, that needs, we're seeing like 5 and 7% fees on mortgages in the buy-to-let market. So if you're borrowing 100 grand, your fee could be anywhere up to like 7,000 quid.
Yeah.
See, that's 14 grand. That is a lot of money, and that is going to the lender to provide that mortgage with a higher interest rate.
Yeah, yeah. As well as that, you'll be able to discuss. I know this is more of the accountant side of things, but you'll be able to discuss whether it's worth buying it in a limited company or within your personal name, for example, for a buy-to-let.
Sure, it's something that does need to be mentioned. You mentioned as well, which is important, that I can't give any tax advice, but I will give people the options available to them. If you buy it in a personal name, if you have a buy-to-let in Joe Martin, is any profit earned from that property is going to be taxed on top of your personal income. If you buy it in a limited company, it has to be one set up specifically for buying, selling, renting properties.
Yeah.
If that business is a zero. So it's going to be taxed at the end of the year when you put your first year's figures in. It might have earned £5,000 profit. It's going to be taxed as such as that as a business, rather than you doing a tax return and it going onto your personal income.
So have you seen more people go into the market as a limited company over the last couple of up to, I think it was 2015 started talking about it. So have you seen like an increase in landlords buying through a limited company rather than through the personal name or not?
I would suppose so. I've never really done any reports on it, and the software that we use like for storing client information, the CRM, doesn't do that, which is a bit of a shame. But it's definitely a no, one size does not fit all.
Yeah.
So the advice on TikTok, buy it in a limited company, do it this way. I'm like, well, that probably isn't right for you, or doesn't align with your plans. So again, we've touched on it before, is I have to think like a game of chess or a game of snooker. So I need to think several moves down the board as to, am I going to checkmate you in 5 years, come to do something, you go, well, I didn't know about that. So I need to think so far ahead. And that's why having a good chat with the clients to see, why are you doing what you're doing? Is it a short-term thing? Are you in it for the long haul? What are your plans that could affect the advice that I give today?
Yeah, yeah, definitely. Obviously, as well as the diligence on your side as a individual and investor, you will also need due diligence on a property as well. You actually help me a lot with this because I get excited by property deals a lot. I come to you and go, Matt, what do you reckon to this? You go, no, fuck off. No, you're not doing it. It just doesn't work on paper. In terms of it's too risky for me at the moment, maybe. But yeah, I just wanted to discuss a bit about that.
Sure, there's several bits to why we should buy a property. So people think that the tagline for my business is more than just the mortgage broker, because people go, oh, you're just the mortgage broker. I'm like, yeah, well, a little bit more than that. So if you're buying with a sizable deposit, which buy-to-let's a minimum 20-25% deposit of the purchase price, and that property was, for example, sold last year, the bank may not do a survey on that house. They're not going to go out and visit it. They will look online on Google Earth, Zoopla, Rightmove, and go, that's fine. Because all the bank is interested in is, can we get our money back, either by monthly repayment, sale of the property, or repossession in a worst case scenario. Now, if we're buying that to live in or to let out, that's our investment. We need to make sure that property is okay. Is it worth the money? Is it an absolute wreck? It might look okay, but we need to get an independent survey done.
Yeah.
Do that independent of the bank and the estate agent. And the reason being is that there's then there a conflict of interest. So we let the bank do their initial checks, whether that's online, they do a drive-by, or they may go out and have a look at the property to value it. Once it goes to mortgage offer, that's when I discuss with my clients is I would recommend getting an independent survey done on that house. And you can have a level 1, which is a basic valuation, say it's worth 250 grand. A level 2, which is a home buyer's report, which is an overall condition report of the property, which always will look for and find problems. Some of these are minor, like the windowsill needs painting, or the bathroom window is blown, it needs replacing, or a building survey. Now, in my area, we've got properties going back 200-300 years that people are buying. It stood the test of time, but is it leaking like a sieve? Does the roof need replacing? Is the subsidence, which is where the property is sinking into the ground? That could be from collapsed drains, putting water into the ground and it's sinking. Heave, which is normally due to large tree roots. Is the like Japanese knotweed, which is a very invasive and very aggressive plant that will bury through pretty much anything. Damp, check for damp. Because if you go and look on a rare sunny day and the property's bone dry and it's not rained for 3 days, perfect. As soon as it rains, that water can then come into the property and cause no end of problems. So the Latin, one of the few bits of Latin I remember is caveat emptor, which means buyer beware. So always have a chat about getting an independent survey. That's one aspect of it. The other aspect of it is what the solicitor is going to do on that house. Is they're going to check the title, they're going to check the land registry, they're going to check to see if there's any do you know, it's completely escaped me, which is slightly annoying. Covenants, but in the deeds of the property, there will be a list of covenants, and they are what you can and you cannot do in that house. So you may not be able to let it out. You may not be able to turn it into a holiday let. Things like you're not allowed to hang washing out the window, which is a common one in flats. Things like that, you need to be aware of these. The solicitor will check those to make sure that is a valid purchase. Now, your survey can cost you up to £1,000. Solicitor costs around about £1,500 with VAT and disbursements. So you could spend £2.5 grand on a property fees and it not go anywhere, because both sides could report back to go, this property's a dog. It's not worth living in. It's not worth the money. It's got 50 grand worth of work need doing, and you can't then let it out to. So measure twice, cut once, and you, which I can get people in touch with, a qualified surveyor, good solicitor who's going to update us all in the process. You should go into it with your eyes open, and knowledge is always power.
Yeah, love it. Sometimes you do need different products and stuff like that as well. So I know we've had discussions about buying for a bridge, and sometimes that might actually be better for your particular circumstance. But talk about like the difference between like the buy-to-let side of things and then obviously going for a bridging loan as well.
Sure. So if you are wanting to flip the property, so buy it undervalued, do some work to it, sell it at an increased value in 6 months, you cannot use a normal mortgage for that. The lenders will not allow it. We will get into trouble if that is done. And the client on the credit file, it will see you've had a mortgage for 6 months, sold it, another mortgage for 6 months, sold it. They'll know exactly what you're doing. You'll get declined, and it's fraud. So if you are buying it to flip, bridging finance is the way to go down that route. And there's different aspects of bridging finance. Again, there's no one size fits all. If the property is uninhabitable, so it's a shell, and the lenders want ideally a kitchen and a bathroom for it to be habitable. Because again, if we think the lender thinks from the worst case scenario upwards, is they think they're going to repossess that property in 6 months. Will we get our money back? If it's not livable now and the client does no work to it, it's not lettable in 6 months. They probably won't be able to sell it. So they want it to have a working kitchen, working bathroom, and habitable. State of decoration doesn't really mean a thing. I see some properties that have come straight out of the 60s with the avocado and bathroom suites and all that jazz. And that's cosmetic, and that can be done. That'll all come back into fashion one day. So, and you need to as well is costing it out. How much is a new bathroom going to cost? How much is a new kitchen going to cost? If it's got a back boiler or things like that, and you need gas central heating, what's that going to cost to do? So if it's habitable and you're looking to rent it out, it's got to be a buy-to-let mortgage specific. You can't rent out to family members. That then becomes regulated, but we can go down lenders' routes that would allow that. So it's definitely not a one size fits all, and I will uncover this in the initial fact find of what you're looking to do, what are your future plans for it. And it's like having a quiver of arrows. You think, right, we'll use that lender. This is the process we're going to go down for you on this particular transaction.
Sometimes you're a bit wary of going through bridging loans. Essentially, if you're quite new, you're paying sometimes, is it 1% per month? It's or 12% per year. Is that right?
It vary depending on whether it's a regulated or unregulated, the state of the property, and all sorts. But what bridging finance does, it rolls it up. So you don't make any repayments on it while you have the bridging loan. But what they will do is they will put that interest on the first month, and they will put the interest then on top of that for the second month. So it compounds. And then when the property is sold or remortgaged into a residential or a buy-to-let, we pay back the original loan plus the interest for how long we have it for. But what bridging lenders look for is ultimately, what's your exit strategy? If feasible. If it's a shell of a property and you're not in the trade or have access to these people, is that possible? Are you going to be able to get it done within 6, maximum 12 months? And also, if that interest is compounding up to 12 months and we do the work on the property and we always run into problems, have we broke even on it, or worse, have we made a loss on it? So this is what I look at with my clients. Is sometimes I go, don't even entertain that. That you're not going to make any money on that house. I turn away business, which is there's brokers out there who would do it, go for the quick burn. I pride myself on my reviews and my service that people will then come back to me and say, use Matt, he's a good lad. He actually told me not to do business, but I'm going to come back to him next time.
Yeah, yeah. So obviously we've covered all to do with the due diligence of the property, of the actual product. But how do you actually find the products, and what sort of software do you use behind the scenes?
Sure. So we have a piece of software that I would love to have had years ago when I first became a broker. But what we do is we feed in the known information. So the purchase price, the deposit, how long we want it for. So for example, 200 grand property, 50 grand deposit, 150 grand mortgage, over 25 years on a 2-year fixed rate. And then we press the source button and it will then look at, on that 2-year fixed rate, the true total cost over the 2 years. Interest rates don't come into the picture, is we look at that true total cost. So quite often I come back to a client with a solution once we've run the affordability and the criteria checks on that lender. And they will then come back and go, well, actually, there's a cheaper interest rate available with XYZ. And I'll say, yeah, well, that's got £1,000 fee associated with it. And you're saving £10 a month by having that lower interest rate. That's 240 quid over 2 years. It's not viable. Or it's regional. So some lenders, the smaller building societies, have products that you can have all over the country, or they're available only within their postcode area. They'll have a loci around that area to say, unless you live within 10 miles of the building society itself, you can't have that mortgage. So and it varies on the loan amount as well. So as you increase the loan amount, paying £1,000 arrangement fee, might save us £100 a month, just 2,400 quid over 2 years. So my software will do that in seconds. It's a wonderful piece of kit. But then when we look at which lenders are coming out top, as in who's got the cheapest cost over 2 years, we then need to check affordability with that lender. And each lender has their own affordability calculations. How much they'll lend against your income. Are they building in ONS data, your Office of National Statistics, of what a 30-year-old person with one child, age 4, will spend monthly? What do they need as disposable income? And it will then say that person can lend 50 grand. I check with another lender, 70 grand, another lender, 100 grand. And it can be, the difference can be that aggressive.
Yeah.
We have to check criteria. So it might fit on the affordability. They'll lend them exactly what they need to buy the house, but they've only been self-employed for 1 year. Or they've got a visa from Hong Kong, or it's a high-rise building, or it's timber framed, or it's prefab concrete. All of these things that we need to be checking. So you could tell the client, oh, you can borrow 100 grand, off you go. They come back and go, didn't think of that. So you need to think like the chessboard example I used before is I need to think, hang on a minute, we could make sure this doesn't bite. So the client doesn't go and fall in love with the property, make an offer, and then we discover that they don't lend on that particular kind of property or that particular kind of income. Yeah. So it's very much like fact find is vital to finding out these potential risks that we can run into.
With this software, can you change the figures based on their ambitions or goals to get into a certain position? Say, for example, so say if they're employed, they say, right, I've got a promotion that I could potentially be on X amount. Can we run the numbers again and see what it might look like in 3 months? I know the markets will change and stuff, but have you got that ability to do that?
Absolutely, we can do that. We can base it on what they are going to do, and even if they're going from employed to self-employed or self-employed to a limited company. I've been speaking to some clients. I think the longest at the minute is 2 years and still hasn't bought a house, but keeps in touch with. So, and people get ideas of pay rises, people get, they know we can even do a mortgage today for a teacher, as a classic example, who might be their first job. They're starting on the 1st of September. I've got a letter that says they're going to be on 40 grand a year, starting 1st of September. I can write them a mortgage today.
So brings us nicely on to my own story, because I did that as well, didn't I? So I was on a lower amount of money, and then I knew that I was getting promotion in the next couple of months. I was able to get a letter say I'll be on this X amount in 3-4 months or whatever it was at the time. We were able to get lending based on future employment, which is really good.
Not all lenders will do that.
No.
Some will. Some want 3 months pay slip, some want 1 year's continuous work history. So that's again where you start. We've got access to 90 odd lenders or something.
Yeah.
You might look at one and go, oh, we can't do that. You need 3 months pay slips. Where I can go, well, no, actually, we can do that because we've got the contract. I know exactly who will lend on that.
I've got a few friends that are self-employed, and they look at employed people as if they're more likely to get a mortgage. Is that necessarily true? Or does it just depend?
Is they look at it different ways. So if you're employed and you're on 40 grand a year, your pay slips will show that. When you're self-employed or a limited company, it's two very different things. They look at the income differently. So if you are a sole trader, for example, a tradesperson, they're going to look at your net profit, and they're going to want ideally 2 years books for the net profit. So if you earn 20 grand in year 1 net profit, 40 grand in year 2, is they will more often take an average of those two figures. So you'll be classed as earning 30,000 a year. Now, some lenders will allow us to use the latest year, so 40 grand, if it makes sense. So it's not been a massive jump, it's been progressive, it's going up. They bought a van in the first year, second year they got less expenses, they got more jobs. That stacks up. That's sensible lending, responsible. If you are a limited company, and you can be a one-person limited company like me, is to look at your salary and your dividends, and they'll work the same again. So they will take an average of year one, year two, or if it makes sense, some lenders will let us use the latest year's salary and dividends. Now we can take that a stage further, is with a limited company, I've always got a pen in my hand, lenders can look at your retained net profit. So if you've not took every single penny out of that net profit, of your retained profit to pay dividends and that kind of thing, if it makes sense, they will look at it. So very much it's having that quiver of arrows to see where can we steer this? Are we going to be able to get the borrowing we need, or can we get more borrowing by using retained net profit or latest year's figures, salary and dividends? So I've got all manner of tools that I have at my disposal to be able to look at that, to see what do we need to borrow? Does it make sense? Is it affordable? Can we get more borrowing elsewhere by using a different means? So I mentioned on the 2 years as well, is some lenders will let us have 1 year's worth of figures. So if you started as a sole trader at the start of last tax year in April, you're able to submit your first tax return for 2023. Is if you were an employed bricklayer before and you've gone out on your own and you've done 1 year's worth of books, is they'll look at that because you've got experience within the field, you broke even, you're going to continue the lend on that if it makes sense. So if you were a bricklayer employed before and you go to be a self-employed dentist, they're probably not going to allow that borrowing. It's not responsible because are you good at your job? Have you got experience? So if you are self-employed, absolutely speak to me at any point, even if you're just starting or you're thinking of going self-employed, because it could impact if you've got a mortgage now, are you going to be able to remortgage? Or if you plan to move next year and you're planning on going self-employed in 6 months, we're going to stick ourselves.
Yeah, that's true. So we've covered limited companies, covered self-employed, we've covered employed. But what happens if you don't have a job and maybe potentially come into money from inheritance or whatever? Is that possible to get on the property ladder without a job and without any income at all?
For a residential mortgage for you to live in, no. You need an income yourself, and I'll say there is some exceptions to that rule. There are other ways to do that, which I will touch on. But if you are looking to buy an investment property, so a buy-to-let, you are able to get that with zero income, because the lender's going to look at the rental figure against the property value and how much we're borrowing. Is it feasible? And also what we look at there is alarm bells start ringing both in my head and the lenders. Is that client going to let that property out? Or is that going to be used at what they call a backdoor buy-to-let? So they're going to buy it under buy-to-let terms, but then live in it, which is mortgage fraud. So we need to be careful there. Now, a client could buy a property with no income or very little income to live in, with somebody else joining them on the mortgage. That's known as, it's a bit of a tongue twister and nobody will understand it. It's called joint borrower sole proprietor, which doesn't make sense in the industry, let alone for the consumers. So what somebody can do, and this works for people who are maybe just starting, we do junior doctors like this, or somebody who's recently qualified, or somebody who is at university, is a parent, friend, can join them on the mortgage, but not on the deeds of the house. Now, they need to get independent legal advice, and I always do a feasibility check on who's the person, why are they doing it, is there a way of us to get out of that in the future years? So if they are a junior doctor on 30 grand a year, but in 2 years they're going to be on 80 grand a year, we can then remortgage and take that other person off. So it's people think, oh, I can't get a mortgage because I'm only on this, or I can't get a mortgage because I run the house on a day-to-day basis. We can. There's a way to do it.
Okay, going back to my own personal story, Matt. Obviously, I've always had this dream of building a portfolio, getting into property, becoming a landlord, and get into the property business. But you kind of stopped me in my tracks and said, "No, let's get your first residential first."
Yeah.
And I said to you, "Well, why do we need to do that?" And you said, "Right, let's get your first residential first. Can you just explain the reason why behind that? Because hopefully that's adds some value to someone who's wanting to get it started in property, like myself."
Very much so. So we need to factor in stamp duty here, which is paid on the purchase price of the property and the means of which we're buying it, be that to live in or to rent out. So if your first transaction is a residential one, so you're going to live in it, is stamp duty is quite kind. So use an example of a £250,000 house. If you buy that as a first-time buyer, your stamp duty is 0. If you buy a investment property first while you still live at home or you don't have any income for 100 grand, you'll pay a small amount of stamp duty on that. But if your future plan is to then buy a residential property for you to live in, or you're going to move in, buy together with your partner, and you've bought that first property as an investment property for 100,000, if we buy it £250,000 again for us to live in, we're going to pay £7,500 stamp duty. So knowing what these next moves are, which I'll uncover in the initial chat that we'll have with the client and ongoing, I need to think, right, you want to do that today, what are your plans?
Yeah.
Making sure I don't do a transaction today and then snooker you further down the line when you come to buy your dream home, and then I say, oh yeah, stamp duty is going to be £7,500. You'll be like, thanks, Matt.
Right. Yeah.
Thank you.
So it's like playing a game of chess, isn't it? One pawn forward, and then you start building your portfolio after that. And that actually makes buying a buy-to-let, getting a mortgage through a buy-to-let actually easier. Is that right? If you've got a residential already, lenders will look at that and go, well, they've already got property already.
Absolutely. They like that experience. There is exceptions to it. You can buy an investment property as a first-time buyer, first-time landlord with no income. That's possible. But to do it the traditional way, which lenders prefer, and to be honest, I prefer it myself as well. You will experience of living in a house, paying a mortgage, then move on to a buy-to-let, which is let out on a tenancy. Now, I get an awful lot, particularly living in the Peak District, inquiries of holiday homes. People who got no experience wanting to get a holiday home. Lenders don't like it as a general rule, because have you got any experience of letting out properties? Are you going to be able to turn it around in time? So then they want it done a different way. Is own your residential property to live in, have a buy-to-let property to rent out, and then look at the short-term let, Airbnb, holiday home, that kind of thing.
There's other criteria, like general criteria that lenders look for. Can you give like a very general overview of that, like to put yourself in an ideal position to actually get a residential and then a ideal position to get a buy-to-let mortgage in your personal name and limited company? I know that's quite a big question, but I'd like just to give you a journey through how someone can get themselves in a position to actually get themselves a portfolio.
Speaking to an experienced broker, the earliest part of the process, even if you're wanting to buy next year, speak to an advisor first, because what we'll be doing is looking at your credit file, looking at your driving license, bank statements, wage slips. Does everything have the same address on? If people have come out of uni They've probably got bank statements going to mum and dad's, driving license registered to the student house, wage slips going to the house they're renting now. Lenders are going to look at you and go, who are you? Where have you been? Also, by looking at that credit file, is we're going to be able to see is, have we got any credit cards that are near the limit? Have we got any credit cards, excuse me, with a zero balance on but a 10 grand limit? Lenders don't like that. Also, if we were in a student house or an old rented property, has there been any bad debts put against our name? Making sure the credit card payments are up to date, that kind of thing. So having a good credit file is we know what the lender's going to see when we send it in. So before we do all that work, let's make sure it all makes sense. Having a look at the bank. Are we overdrawn every month? Are our friends sending us money for a taxi on a Friday night and labelling it? And I've seen them all. I have seen some horrors. Don't let your friends transfer money with very funny descriptions on your bank statements.
Really?
I've seen. I can't probably nothing I can go out online, Joe. Things like that. Making sure so when the lender sees it, it's going to make sense. And also your deposit. Where's your deposit coming from? Is it from build-up of savings? Is our family going to put £1,000 in each? These deposit sources are important. So that's something we want to make sure that money isn't coming in from everywhere, because I've got to do my due diligence on the deposit. The lender will do theirs. The solicitor will do an even higher level check, because like the lender works from worst case scenario upwards, solicitors will think that we are money laundering.
Yeah.
So even if it was £1,000, they're going to do their due diligence checks on that to make sure it is coming from Granny and she saved it in a bank for the last 12 months, and then she's going to gift it to say it's £1,000. And that deposit can come from other sources. Lenders will allow some to come from the boss. Can you imagine that? Friends. So me knowing where this deposit's coming from is going to allow me to steer it to a particular lender who will then say, yeah, we accept that. If it makes sense, it's got to make sense. Giving people an idea of what they can borrow, and as well, how much is that going to cost? Is it affordable? Is it better than renting? That's the best thing. People will often come to me if I've not spoken to them and they've already been to view a property. They've had a second viewing with the folks. They've shared it with their mates on social media. They've got all excited. They've moved in. They come to me. I'm like, you've been self-employed 6 months. I can't do it till next year. And I have to shatter dreams, and it's horrible. It's a horrible call to make.
Yeah.
So knowledge is power. Speaking to a professional earliest possible opportunity, so I can look at the pitfalls. Because what I look at is like a pyramid process. So we do all of this fact finding and discovering addresses, credit blips in the very early part of the process, uncover where the deposit's coming from, looking at their employed or self-employed income. Are we using any bonus, commission over time? Are we using any child benefit? How old's the child? Is that going to stop in 5 years? Is it feasible? All of these things we do. So when we get to the very last bit of the process, job's a good one. Or like, I've not put you as Joe Martin on the application, and then it comes to the solicitor and he goes, he's actually called Joseph.
Yeah.
Or I've spelt your middle, I took your name down and spelt your middle name wrong.
Yeah. Well, most people do, to be fair. So that's your residential one.
Yeah.
Buy-to-let slightly different. You know, you got your. It's not all about yourself, is it? You know, you got other. The more, is it right? They're more interested in the property, so the rental coverage.
They'll do those same checks on you, whether you buy as a personal name or a limited company. But when they look at the investment properties, I always tell a client, if you're looking, we need to know several things. We need the purchase price, which will then determine the deposit. 25%, ideally, a quarter of the purchase price. And also, what is the rental figure for that property? Because it needs to be able to fit with the lender. And also, from your perspective, is it worth doing? Is it actually going to cost me money to run that property and let it out? Or, because renting with buy-to-let properties, there's two avenues that you need to consider is the capital growth of the property. Is it going to go up in value? And what it's going to return on a monthly basis. So doing, which you've done, which has always been you're a dream client, is not, you know, what that property is going to be worth once it's renovated, and this is what we can rent it out to tenants at.
Yeah. Obviously, you got your property due diligence as an investor, so you won't find a property for them. That's your client's job to find a good property. You're there to make sure the purchase is right. They've got everything in place, and they're actually thinking long term, thinking, is this going to work in 10 years' time? And am I going to be glad that I've done that, or is this going to be a headache? Because you'd sooner find out earlier if it's going to be a bad investment or not. And that's your role. You're level 2 essentially. But level 1 is yourself as the investor going out finding the deals. Level 2 is speaking to a professional like yourself.
Absolutely, yeah. You know, we can run the figures. Some of the rental calculations are relatively easy with the software, as we'll put in 200 grand property, 150 grand mortgage, £1,050 a month rental. It will either say yes, no, or you need it to be this to be able to do it.
Yeah. Well, thank you very much for coming on today's podcast, Matt. If someone is looking to get in touch with yourself, if they're looking to a residential buy-to-let in their personal name, in a buy-to-let in their limited company, where can they find you and how do they get in touch with you?
I'm on LinkedIn, Instagram, Facebook. It's Mercian FS, Mercian. The branding is trees. It combines my love of nature and history. And I can do calls to suit clients. I've done clients this morning on a Saturday morning because it's convenient for them. So, or you can give me a call. The office number is 01298 80 80 83. And yeah, look forward to helping.
Very good. Well, I'll leave your phone number and your email address and your website link in the show notes down below, guys. So make sure to speak to Matt. He's free pretty much whenever you need to get in contact with him. I've always messaged him on WhatsApp. So yeah, definitely do that. And thank you very much for watching today, guys. And I'll see you in the next episode.